For those who may not know, the Bank of Japan's ultra-easy yield curve control policy targets some short-term interest rates at -0.1% and the 10-year government bond yield at 0.5% above or below zero in an effort to sustainably achieve 2% inflation. But now, investors are testing the bank's commitment to capping bond yields with inflation rates being above the bank's target. Now, when the Bank of Japan first adopted the yield curve control policy in 2016, the goal was to prevent interest rates from falling too low. But, as the years went on, inflation remained stubbornly low, so the BOJ had to maintain the policy for longer than expected. And as a result, bond yields have been hugging a tight range and trading volume has decreased. But with inflation eroding those gains, investors have sold bonds, pricing in the chance of a near-term rate hike. The BOJ has ramped up buying, including through offers to buy unlimited amounts of bonds to defend its yield cap. However, this has been criticized by analysts as distorting market pricing and fueling an unwelcome yen plunge that inflated the cost of raw material imports. Haunted by a history of political heat for dialing back stimulus prematurely, the Bank of Japan wants to avoid raising rates until it is clear inflation will sustainably hit the bank's 2% target, backed by higher wage growth. But markets may force the BOJ to relent, breaching the 10-year yield cap before massive BOJ bond buying brought the rate back down. So that the Bank of Japan's attempt to avoid raising rates until inflation is sustainably at the target and wage growth is higher is an effort to maintain a healthy and stable economy and avoid any volatility in their financial system. This is certainly going to be an interesting one to watch.